Welcome to this deep dive. Today we are on a mission to help you navigate the newly opened 2026 tax season and unpack the monumental One Big Beautiful Bill Act, or OBBBA as it's been called.
Yeah, OBBA. It's definitely a massive one.
Right. We've got a really fascinating stack of sources for you today. We're looking at official IRS filing updates and some wealth management strategies from JP Morgan and, of course, the comprehensive legislative records.
Which is a lot of paper.
So much paper. And because this bill is, highly politically charged, we're doing what we do best. We're remaining strictly neutral and stripping away the spin. We just want to act as impartial guides to the facts and show you exactly what the numbers say for your financial future.
Right, because it really is a massive shift in policy. Understanding the nuts and bolts of these differing viewpoints and documents is just crucial for your financial planning this year.
Absolutely. So let's just sort of unpack this. The big takeaway from the new IRS Schedule 1A is that the tax code is heavily pivoting to incentivize specific working class labor and domestic purchases, too.
Yeah, they're doing that with some very targeted write-offs.
Right, and here's where it gets really interesting for your wallet. First up is the no tax on tips provision.
Right.
This allows specific workers to deduct up to $25,000 in qualifying tip income. And then there's the no tax on overtime deduction.
Which is huge for a lot of people.
It really is. That offers up to $12,500 for time and a half pay required by the Fair Labor Standards Act.
But keep in mind, there is a ceiling there. Both of these deductions completely phase out for individuals making over $150,000.
Exactly. Oh, and if you bought a U.S. assembled vehicle between 2025 and 2028, you can now deduct up to $10,000 in auto loan interest.
What's fascinating here is the introduction of what the legislation officially calls Trump accounts.
Oh, yeah, I saw that in the stacks.
Starting in July 2026, parents can open these tax-advantaged investment accounts for their children.
And the federal government is actually seeding these accounts, right?
Correct. They are providing a $1,000 contribution for every U.S. citizen child born between 2025 and 2028.
Wait, so every single kid born in that window gets $1,000 tied to the market?
Exactly. It functions essentially like a child IRA, but it is required to be tied to U.S. stock indexes like the S&P 500.
Wow.
It's unprecedented market participation from birth.
Okay, so while those accounts are focused on setting up the next generation, what are wealth managers telling high earners to do with their money right now? That brings us to JP Morgan's latest strategy brief.
Yeah, the rules for charitable giving are definitely shifting in 2026.
They really are. Deductions for charitable contributions are now capped at 35% for top earners. And you can only deduct the amount that exceeds 0.5% of your adjusted gross income.
To put that in perspective for you, if your adjusted gross income is $1 million, you can't even start deducting until your giving crosses a $5,000 threshold.
Which is exactly why JP Morgan strongly advised high-income earners to front-load their donations back in 2025 to maximize their tax benefits.
Because they saw these tighter limits coming. If we connect this to the bigger picture, the macroeconomic scale of this legislation is staggering. The OBBBA permanently extends the 2017 tax cuts. But you have to pay for that somehow.
Right, the ledger has to balance.
And according to the legislative records, they balance it with over $1.2 trillion in federal spending cuts.
Wow.
Yeah, and these heavily target the social safety net, specifically Medicaid and the SNAP food assistance program.
And they're doing that primarily by introducing strict new work requirements.
Yes. For instance, many adults are now required to log at least 80 hours of work a month just to maintain their coverage.
Man, and the systemic shifts keep going. The legislation rolls back several clean energy credits from the previous administration to make way for new fossil fuel incentives.
Right.
Plus, it allocates a massive $170 billion toward border security.
To give you a sense of that scale, that funding makes Immigration and Customs Enforcement, or ICE, the highest funded federal law enforcement agency in the country.
But of course, every ledger has two sides. We are impartially reporting a massive divide here. Proponents are celebrating the economic growth, the working class tax relief, and expanded school choice.
While at the same time, critics and the nonpartisan Congressional Budget Office are waving a massive red flag.
Right.
The CBO estimates this law will increase the federal deficit by $2.8 trillion over a decade. And circling back to those strict new work requirements for Medicaid, the CBO projects that 10.9 million Americans will lose their health insurance simply because they won't meet those new thresholds.
So what does this all mean?
That's the big question.
Ultimately, the OBBBA fundamentally rewrites the U.S. financial landscape. Whether you are a tipped worker cashing in on the new deductions, or a high earner mapping out charitable gifts, or just someone trying to understand the macroeconomic shifts happening around you, this requires incredibly careful personal tax planning moving forward.
It really does. And this raises an important question to leave you with. With the new Trump account automatically tying millions of children's savings directly to the S&P 500 from birth, how might this unprecedented government-sponsored market participation reshape the next generation's entire psychological relationship with capitalism, risk, and retirement?